Welcome back to the deep dive. Okay, if you've looked at the crypto charts today, September 25th, 2025, you're probably feeling, well, a bit of a chill.
Yeah, definitely some red out there.
But we're not just here to stare at the candles. This single day, it's like a huge collision, isn't it? Short-term financial stuff, big macro risks, and some potentially historic institutional moves all happening at once.
It really is a high-stakes environment. And for you listening, our mission today is to give you the shortcut to understanding these forces.
Break it down for us.
Right. We're basically looking at two huge narratives pushing and pulling the market. First, there's the immediate, sharp volatility from the largest options expiration event, well, ever recorded.
Ever.
Yeah. And then balancing that out, you have this longer-term structural shift happening. Big financial institutions are finally laying the groundwork, really embracing stablecoins. That's the quieter but maybe more profound story.
And the market's definitely feeling that first part already. We saw a pretty broad sell-off this morning. And the immediate fallout. Ethereum, ETH, just slipped below $4,000 first time in, what, 48 days?
That's right, 48 days.
That kind of sudden reversal. Well, that's exactly what happens when short-term leverage meets, maximum fear. Okay, let's start with that immediate fear then. The sheer size of this short-term pressure. Already today, even before the main event, we saw something like $900 million in long positions liquidated.
Yeah, almost $1 billion.
Yeah.
And that's forced selling. It just sucks the strength right out of the market.
And this isn't just random selling pressure, right? It's all happening just before.
Exactly. It's happening right before the deadline for the single largest options contract expiration this asset class has ever seen. We're talking a frankly mind-boggling $23 billion.
$23 billion, that's astronomical. Is that pressure mostly on Bitcoin and Ethereum, or does it spill over everywhere?
Oh, it spills over. It becomes systemic because major assets like BTC, ETH, XRP, SOL, they're all deeply involved in that options market. And the pressure gets worse because this huge expiration forces massive short-term volatility. Traders, they can't just wait it out. They have to adjust their hedges, their positions now.
Right now.
And that scramble to adjust creates this huge uncertainty, which makes the bigger players just want to pull back to reduce their risk exposure dramatically.
And it feels like the timing couldn't be worse with all the external macro stuff happening. Like, that's adding fuel to the fire, forcing traders to de-risk even faster.
Absolutely. You just can't ignore the backdrop here.
Yeah.
The potential for a U.S. government shutdown is looming, right?
Yeah, end of the month deadline.
Exactly. And a shutdown means broad economic uncertainty. When traditional investors get nervous, what's the first thing they sell?
Risky assets. Crypto often tops the list.
Always. It triggers a flight to quality, or perceived quality anyway. And that just pours gasoline on the fire already burning from the options expiry pressure.
So stepping back from the daily charts for a second, Fidelity Digital Assets put out something interesting connecting this to the bigger cycle. They suggested this whole market cycle might be entering its, what was the phrase, final acceleration phase.
Yeah, and that phrase, final acceleration phase, is really crucial. It suggests we're not just in some mid-cycle dip.
Right.
It frames this potentially as the last, most dramatic chapter. If they're right, and we are entering that phase, you should brace for extreme volatility.
What does that look like?
Think faster, sharper rallies, followed by brutal liquidations, whiplash price action. For anyone investing, it means risk management. Knowing your entry and exit points becomes absolutely critical. The market gets very, very efficient at punishing leverage in that kind of environment.
Okay, so twin pressures, options expiry, and macro fear. Let's look at the metrics. What are they telling us about where the pain is and where the capital is actually moving right now?
Well, no surprise, BTC and ETH are fighting just to hold on to key support levels, but it's really the altcoins taking the brunt of this risk-off move.
Seeing that across the board.
Yeah. Tokens like AVX, for instance, are seeing significant drops, not just in price, but also in open interest.
Explain open interest quickly for us.
Sure. Open interest is basically the total value of all outstanding derivative contracts, like futures or options. When it falls sharply alongside price, like with AVX, it confirms that traders are actively closing out their leveraged positions. They're deleveraging quickly, not just waiting for spot prices to fall. It signals real capitulation.
Okay, so that's the financial damage. What about the mood, the investor psychology? That often tells you where the bottom might be forming.
That's where we look at sentiment indices. The Fear and Greed Index, currently sitting at 44, that's firmly in fear territory.
Still fearful.
Still fearful. And while that fear feels painful short-term, you always have to respect that. It does raise that strategic question for long-term folks.
The contrarian signal.
Exactly. Extreme fear can, historically, signal a potential buying opportunity. It lines up with that classic idea. Accumulate when others are panic selling. Doesn't mean it's easy, but it's something to consider.
And internally within crypto, we need to watch how capital is shifting. Bitcoin dominance, BTC.D, is at 58.2% right now. What's the actionable takeaway from that number for you listening?
Right, BTC dominance tells us if money is flowing into Bitcoin relative to everything else or out of it. At 58.2%, it shows investors are still huddled in Bitcoin, seeing it as, a relatively safer place compared to the more volatile alts.
That's quite high, isn't it?
It is, historically speaking. For a real altcoin season to kick off, you'd need to see BTC.D fall confidently, maybe get below 55% and stay there.
Yeah.
So watching that level is key if you're trying to spot the next big rotation into alts. Until then, capital seems to be playing it safe in Bitcoin.
And one last piece, that crucial pillar for this cycle, institutional interest. Seeing some short-term strain there, too.
Yeah, the pace of inflows into the U.S. spot Bitcoin ETFs has slowed down. That's a critical signal.
Why critical?
It suggests a temporary pullback in institutional demand. Big money tends to step back when volatility spikes and macro uncertainty is high, like now. So this pause, combined with the options pressure, definitely adds more downward weight on Bitcoin's price. Doesn't mean institutions are gone, but they're clearly waiting, assessing the risk.
Okay, it's easy to get caught up in the short-term panic, the leverage unwinding, the red charts.
Very easy.
But we have to remember, like you said, while the market panics short-term, the structural building doesn't necessarily stop. Let's shift focus to the institutional foundation being laid right now, moving from fear to maybe long-term adoption.
Yes, and this is where you really see the space maturing. It's actually fascinating. The current volatility is all about native crypto leverage, right?
Right.
But the long-term stability is being built by the traditional finance giants. Regulatory clarity is finally turning into real action, starting significantly in Europe.
You're talking about that group of 9 major European banks, including big names like ING, Unicredit.
That's the one. And what they're doing is pretty profound. They're collaborating to issue a euro stablecoin. But here's the crucial part. It's being built to be fully compliant with MiCA.
MiCA being the big European crypto regulation framework.
Exactly. Comprehensive rules. The fact that established multinational banks are building a compliant stablecoin set to launch in 2026, that tells you this technology isn't fringe anymore. It's becoming core financial infrastructure.
Meanwhile, here in the U.S., often criticized for being slow on regulation, we're also seeing some important moves toward clarity, aren't we?
We are. The CFTC is actively pushing for stablecoins to be used as legitimate tokenized collateral. That's a big deal.
Okay.
And at the same time, the SEC, usually seen as more cautious, is working on clearer rules for crypto companies throughout 2025. These aren't just small tweaks. Especially the CFTC's move on collateral, that adds a massive layer of legitimacy for stablecoins within the existing financial plumbing.
Right. So this is really the why it matters moment for you listening. This mix of big institutions stepping in and regulators providing clear paths, that's what's needed to actually weave stablecoins into the global financial system.
Precisely. This is the structural pathway. It speeds up the growth of decentralized finance because now it has credible, compliant collateral. It makes cross-border payments way cheaper and faster for big companies. And, critically, it fuels the whole explosion we expect in real-world asset tokenization, RWA.
Tokenizing things like real estate, bonds.
Exactly. Real estate, commodities, private credit. All of that relies on having stable, trustworthy, compliant settlement layers, like the one these European banks are building.
So this is the underlying trend that provides maybe a long-term floor for growth regardless of today's options chaos.
I think that's a fair way to put it. And if you want to track whether the U.S. actually captures this huge potential, you need to keep an eye on key legislation, something like the Genius Act. Its progress, or lack thereof, will be a big indicator whether the U.S. is serious about competing in this digital asset infrastructure race. #outro.
Okay, that brings us towards the end. We've really explored 2 almost opposing themes today, haven't we?
Definitely feels that way.
On one side, you've got this intense short-term volatility. Risk management is absolutely paramount right now, driven by that record $23 billion expiration, made worse by the macro fears.
You have to manage that risk, absolutely. But then on the other side, that long-term adoption story. Arguably, it's never looked stronger. 9 major European banks, concrete steps from U.S. regulators. It shows the foundation of digital finance is being built, brick by brick, regardless of one bad day on the charts.
So you really have to keep both timelines in mind at once.
You do. Focus on both.
So final thought then. What does this all mean for the immediate future, say, the next week? What's the biggest unknown, the most pressing thing you should be tracking?
Well, the single biggest event to watch is how the market actually reacts after those $23 billion in options contracts finally expire over the next day or two.
Does the uncertainty just evaporate?
Possibly. Does that huge weight lift, leading to a quick relief rally? Or does the selling pressure somehow linger? That's the immediate question. But honestly, the ultimate decider for market-wide risk appetite, it still comes back to the macro picture. Specifically, news around the U.S. government's ability or inability to pass a budget before that September 30th deadline.
That's the real cliffhanger.
That's the big one, that macroeconomic hurdle. That's the key pressure point we all need to watch. It will likely dictate whether risk assets like crypto find their footing and rebound, or if there's another leg down to come.